Good evening, everybody. This is Howard Friend here, and welcome to my webinar on the FBR and FBS trading setup. So the presentation is all about trading techniques and in particular, market traps, which I believe are the root cause of some very important moves that as traders, we would like to try to capture. So I call these setups market traps, and they are formed when traders are caught on the wrong side of the market. Usually they form after a technical move, for example, the break of a support level or the break of a resistance level, but often they've got a fundamental trigger, for example, a news-related move. I've developed a trading methodology, which I call break and retrace, to help capitalize on market traps. With break and retrace, this is essentially how the buy setup works. So we start off around a fixed point just before the move to the downside, the break. We get a sharp move to the downside. Now this can be caused by a piece of news, or it could be caused just by a break of a support level. But typically what would normally happen is after a break to the downside, we'd get a little bit of chop and then we'd break again. And that's what most people expect from a move to the downside. But what I'm looking for is a break followed by a complete retracement of that break move all the way back to the point of origin, the point just before the market started to break. Once we get to this point, all of the sellers on or after the break below the line are trapped. And that creates the conditions for the market to rally significantly as trapped sellers bail out of their losing positions. So that's the basis of break and retrace. And I use break and retrace in a number of different methodologies, including FBR and FBS, which I'm going to show you. So with technical break and retrace, what happens? Well, it has to start off with the break. So we get a break, the market breaks below a support level or above a resistance level, if we're talking about a sell setup. And if the move fails to see follow through buying or selling, then those who participated on or after the break will start to exit their losing positions. They start to get a bit impatient. And that's when we start to see the retrace against the break move. Now, as I said before, if all of the move on the on or after the break has been retraced, then a trap has formed, and then we have completion of a trap. We've had break and retrace, and now we can expect a big move in the opposite direction to that of the break. So let's now talk about the fourth break of resistance, the FBR. So this is a bearish reversal setup, and it uses break and retrace methodology whereby the market breaks through a resistance level, and as it does so, people expect higher prices. So what you typically find is when the market breaks a resistance level, you find that short sellers have stops above the resistance level, so they'll be stopping themselves out as the market breaks higher. And also you'll have people who are flat, who don't have a position, who look to anticipate a move to higher levels as the market breaks through a resistance point. So this is typical technical theory. So stops are placed on above resistance levels. So when the market breaks through a resistance level, typically we will see a big move higher, because at that point demand is greater than supply, and that results in a higher equilibrium point price. But in this case, what I'm looking for is the market, having made that break to the upside, to start to reverse and then start to retrace. And that would leave the people who bought the breakout, the break buyers, losing money. So what happens is if you buy the breakout and the market goes against you fairly quickly, is you start to get a little bit panicky. That's the psychology behind it. And then the market starts to decline as people who bought the breakout are exiting, losing long positions. And once we get to a critical mass, in other words, we get back to the start of the move, then we know that everybody who bought the breakout is underwater, the longs are underwater, and the market should go down as long traders start to bail out of losing positions. And that is an opportunity to make money on the short side of the market. Okay, so this is essentially how it looks, the false break of resistance. So what we have in an uptrend, we get the market either making higher highs and higher lows, or we get the market making several thrust bars where the close is above the previous bar's high, several consecutive thrust bars, which indicates aggressive demand. So we get this kind of aggressive demand push to the upside. So the underlying sentiment psychology is bullish. Then we start to get a bit of a pullback as some of these people start to take profits. We get the typical pullback. And after the pullback, we get a resumption of the buying pressure, which pushes the market to the new high. So as I say, typical technical market action is the market in an uptrend is making a series of higher highs and higher lows. Market swings to the upside, corrects, breaks through the resistance level, swings to the upside significantly. But in this case, what I'm looking for is the market to take out the stops that are placed just above the high, seeing a new high, which is the NH. So the R is resistance, NH is new high. So we've broken through the resistance line, the red line here, making a new high for the uptrend. But what I'm looking for the break and retrace to the downside, the false break of resistance, is the market having made this push to a new high to start to sell off and come down like this. Okay, so let's take a look at a few examples of false break of resistance, the FBR pattern in action. Okay, first up is a chart of euro dollar, a weekly chart of euro dollar, going way back when. So the market starts off, has a big swing to the upside, nice double thrust there, close above previous bar's high, close above previous bar's high, aggressive demand. Then the market sees a choppy decline, then starts to form a series of higher highs and higher lows. Typical bull market action. And it gets to this point here, just above 150. This is, again, going back some time. So it backs off from just above 150 euro dollar. Then again, as the trend is up, people come in after the pullback, push the market up to a new high. So we get the market pushing through the red line, which is the previous swing high within the uptrend, pushes through, can't close above it. Next week starts to break down. So we've had a break and a retrace to the downside. So what you can see here is the market participants who bought the breakout, bought the break above this resistance point, are starting to be a bit concerned because they're on the wrong side of the market as the market pulls back. And as push comes to shove, before you know it, within the next couple of weeks, the market is in a full-blown downtrend. So the false break of resistance can provide early warning of an important topping market top, and give you early indication that the market trend could well be changing and that you should at least abandon long positions and maybe think about taking a short position in the direction of the new trend. Another example here, this is a dollar yen, daily chart of dollar yen. So dollar yen swings higher, swings lower, back up again, and then we get this big breakout to the upside with a big long bullish and then it starts to push higher. So at this point, the psychology is undoubtedly bullish. You had a big breakout, a break of this major swing high here. Market pulls back, finds support around the old swing high and this one as well. Buyers come back in and they push it up. So pushes it up, makes a new high, breaks through the swing high, the red line, after resistance, breaks through, closes above it. So looking pretty good on the breakout. So the buyers are in. And then on the next day, these are daily bars. Next day, there is a bit of profit taking. Market closes down a little bit, back below the red line. So the break buyers are now starting to lose money. Then within a couple of days, we start to see the market sell off. Get a retest, and then we break down, and now we're in a downtrend, lower highs and lower lows. So the false break of resistance here gave you a bit of an early warning that the market, although previously bullish, was starting to run out of steam. And just as an aside, you might want to look at the false break of resistance in conjunction with perhaps a momentum oscillator below the chart, because typically when the market is making this new high, we're starting to get the typical divergences that you see at the end of a trend. Okay, dollar Canada, a couple of examples on the same chart. So the market starts off here, big aggressive swing to the upside. Everybody's now long. We get a pullback, people buy the dip, buyers come back in, and they push it through the swing high. So the swing high is defined as a high which is higher than the bar before it and higher than the bar after it. So the market forms a swing high, and then it breaks that swing high within a few bars. So this is typical bull market action. Look what happens when the market does the same thing over here. Aggressive demand, pullback, demand. So what happens here is the market breaks through the swing high, doesn't close above it on the first attempt. Next day, the buyers come back in, they push it up, but the selling pressure comes in, closes below it. Next day, the bulls have another go. They push it through the red line, the previous high, but again, the sellers come out. People take profits, and then by the end of this day, the market has closed significantly down below the previous bar's low, below the red line, and it's not looking too bullish on the close of this bar. Then the market sells off for the next few days. So there's an opportunity there on the short side. Market composes itself here, bases out, starts to form higher highs and higher lows again and again. We get the big aggressive swing to the upside, minor pullback, buyers come back in, they push it through to the new swing high above the red line, push it through, close above, looking pretty bullish at this point, but then the next day, people come in and they sell this market. Down we go. We close back below the red line. Next couple of days, the buyers come back in, trying to push it back above. Couldn't even get back above the red line at this point. We get a reversal day, and then before you know it, the trend is down, certainly for the next couple of weeks. So again, another opportunity to make money on the short side of this market using the false break of resistance pattern. This example is euro dollar, but on a 15-minute chart. As I mentioned, or I may have mentioned, that the false break of resistance can work on intraday charts, and it can also work on daily, weekly, monthly charts too. As with all of the setups that I have created, I would say it works better on longer term charts, for example, daily and above. But suffice to say, in this occasion, the market breaks down and then it pushes up, breaks through the swing high, the resistance level, pushes through, makes a new high, NH, but by the close of the bar, the market is closing back below the red line. So there is significant selling pressure having taken out the stop on the break of the swing high, which is what happened. The market closed quite weak. Next bar, these are 15-minute bars. Within the next 15 minutes, the market started to fall. So you can see that in this situation, there was an opportunity there for the day trader, maybe to scalp 20, 30, 40 points out of this particular market, just using the false break of resistance setup. Okay, so that's the bearish setup, the false break of resistance. And now what works in technical analysis on one side should always work on the other side. So what we're talking about now is the opposite, and it's called the false break of support, the FBS pattern. So FBS is a bullish reversal pattern or setup. And what we're waiting for is the break of a support level. And when that happens, we get an expectation of lower prices, because when the support level breaks, usually the market wants to go down. It tells you that the demand has dried up at that level and that the supply is greater and that the price should go to a lower equilibrium level. So that's the reason why traders place sell stops below support levels. Either sell stops to protect them if they are long, or sell stops to enter new short positions if they don't have a position, looking for that push down to lower levels. So the breakout usually sees follow through selling as a continuation of a downtrend, but if the move stalls and starts to reverse, the break sellers are losing money. And as they're losing money, they start to get a bit nervous. The weaker players will start to cover their losing positions at a loss, driving the market up. So if we get to the point where we've gone all the way back to the origin of the move, then everybody who sold that breakout are losing money. And then push comes to shove, we get a big pendulum swing to the upside, and then the market should go higher. So this is an opportunity to make money from the long side of the market. So this is the idealized picture of the fourth break of support setup. So what we have is the market initially driving lower, close under the previous bar's low, close under the previous bar's low, close under the previous bar's low. Nice aggressive selling. So the underlying pressure is to the downside. We then get a little technical correction, and then the sellers come in and they drive the market down, breaking through the support level where we draw the red line. It can be any color, but I've drawn it in red. We break through the red line, making a new low for the downtrend. Okay. So this is the kind of the setup that we're looking for. This is the break to the downside. Now what we're looking for is the retrace to the upside, and then we've got ourselves a trap which we can capitalize on the upside. Okay, so let's take a look at a few examples of fourth break of support. So this one is cable, sterling dollar, weekly chart. And there are 3 good examples of fourth break of support on this weekly chart. First one here is the market basis, looks like around 154. Push to the upside, aggressive push, sellers come in, retest of the low, makes a very marginal new low, and then next bar the market springs higher. And that gives you an opportunity to trade on the long side, looking for a bit of a flush out that way. Market tops out, starts to trend lower, making lower highs and lower lows on this weekly chart. Breaks through the support level, the swing low. Remember, a swing low is a low which is above the previous bar's low, and it's also above the next bar's low. So this is a swing low, the support level. Market bounces off of that level, forms the swing low, and then the neck on this bar breaks down through the swing low, attracting some selling pressure, because at this point people think that the bears are in control of the market and the market should be breaking down. But after that initial push lower, taking the stops out, buyers come back in, and by the end of this bar we're significantly above the red line. Then the market has a bit of a chop here, and before you know it we have some aggressive buying here. So the fourth break of support was a very good early warning sign that this downtrend had run out of steam and that maybe the market was ready to go higher. So after this multi-week, multi-month swing to the upside, market topped out. Again, aggressive selling here, bounces back up after this big aggressive move, double thrust, 1, 2. So close under previous week's low, close under previous week's low, aggressive selling here. Market reacts higher after the double thrust, and then after that we get a little the sellers come back in, and then we get the push to the new low, breaks through it, closes below it, next bar breaks down but can't sustain it very well, still closing below it, and on this third bar the market makes a marginal new low for the trend, but by the end of that bar the market is aggressively higher, above the previous bar's high, thrusting, and also above the red line, the broken support level. So at this point, we know that the bears have run out of steam. A good opportunity to have a go at the long side of the market. And then that turned out to be the bottom for a very long period of time. This example here is euro dollar. So euro dollar daily chart. So the market initially breaks, we get 1, 2, 3, a triple thrust to the downside here, quite aggressive. Then we get a reversal bar, then a minor double thrust to the upside, and then the sellers come in and then grinding lower. Then eventually the buyers give up, and then the market starts to fall quite aggressively. After this decent sized rally, the market attracts selling pressure, breaks down through the swing low here on this bar. There's the swing low, the lowest point for the downtrend, breaks through it, but can't close below it, and the buyers starting to come in. The sellers at this point are getting a little bit nervous on the close because they've sold it, but on the close they are losing money. Next day comes in, and then we start to see some aggressive short covering, which before you know it turns into the start of a new bull trend. Another good opportunity to think about the long side of this market. Again, if you can line this up with momentum divergences underneath it, which invariably you will, if you look at an RSI or stochastic or one of the momentum oscillators, that will give you some added weight that when we get this little push to the new low, we are on borrowed time. Okay, dollar yen, 240-minute chart, again back to the intraday. So the market for the most part during this phase is in a downtrend. Then we get to this point here where the market breaks through the swing low, but again by the end of the bar the market is significantly above the swing low, and a bullish outside pattern, which is always quite a good indication the market wants to go higher. If it closes near the top, that was a bearish outside pattern which closed near the bottom, and that gives you a bit of a clue that the market doesn't want to go down and in fact may want to go up. So we've had false break of support, and then as the push comes to shove, the buyers start to come in. Before you know it, the trend has reversed. Big move to the upside. Another example here, this is Euro Yen, a weekly chart using the false break of support. So Euro Yen starts off by consolidating, forming a bit of a bearish breakout to the downside. Then we get a triple thrust, 1, 2, 3, correction to the triple thrust, and then the sellers come back in, they drive it down, break through the swing low marginally, bounces back up. So the initial push below is attracting some buying, but not enough. Then another go at the downside on the next bar, breaks through the swing low, and again closes back above the red line, the previous swing low. So we've had two attempts to the downside, which have failed to see significant follow-through selling after the break of a support. So that tells you that the sellers, all these people here who are selling this to the market below the red line, are starting to lose money. For sure, they are losing money by the time the market closes back up here. Next bar, the market starts to move higher as the short sellers bail out of losing short positions. Market stabilizes, and before you know it, we have an aggressive move to the upside. So again, the false break of support is a good early warning signal that a trend is pretty close to ending. So again, use this in conjunction with momentum oscillators. It can be quite a powerful tool. Okay, so now I'm just going to show a few charts with both false break of support and false break of resistance on them. Dollar yen weekly, so the market starts off with a nice false break of resistance top, FBR top. So the market backs off here, forms a swing high, market has a go at the swing high, pushes through the swing high, closes below it, first warning sign. Then the next bar, the market starts to retrace lower. So break and retrace to the downside. And before you know it, we have the start of a downtrend for the yen, a good downtrend. So after hitting bottom here, after this kind of falling wedge type pattern, we get a nice aggressive short squeeze rally up here, pops out just at the gap on this chart. There was a bit of a weekly gap here. So the sellers came in at the weekly gap, drove the market lower. The trend is still down. We break through the swing low, close below the swing low. We've got this new low bar, looking pretty bearish at this point. And then on the next week, we start to get a bit of a bounce back through the red line. So all of the short sellers are losing money. So at the close of this bar, we've got ourselves a nice trap situation, which leads to an aggressive short covering rally here. And by the way, the break through this resistance level also forms an FBR top. So we break through, then the next bar we retrace lower, and then the market falls back for a few weeks. Okay, this one is the Dow Jones Industrial Average, a monthly chart. I just thought I'd throw that one in there because it's always good to see these patterns work on long-term charts as well, particularly at historic market turning points. So what we've got here is the FBR top at the top of the bull market in 2007, and we've got an FBS base at the bottom of the bear market in 2009. So obviously we've not been, we've had an amazing bull market with a bit of a pullback last year in the Dow Jones Industrials, but this was nailing the bottom of the bear market and the start of the major bull market. So just to go through it, what we have is we have the market making higher highs and higher lows, typical bull market action. This came out of the 2003 low, I believe. And then the market hit the resistance level, pulled back, formed a swing high, the red line. Within a couple of months, the market breaks through the swing high. So new buyers are coming in. The last few pips of the market, the bull market, closes back below the red line. So at this point, we've got a few people trapped above it. And then the next month, the market starts to break down. And we know now that these buyers are well and truly trapped. And that turns out to be the top of the bull market, the start of the bear market. On the way down, we have some really aggressive selling here during the great financial crisis. Nice bounce back here. Trend is still down. We break through the red line, looking pretty bearish at this point. And then in comes all the stimulus and the support. The market does a reversal month, and by the end of this month, the market has closed back above the red line, the old swing low, and certainly way above the previous closing level. And that's the trap for the last few sellers of the bear market, and it's been up ever since, pretty much. Give or take one or two pullbacks in the market. Euro dollar daily chart, again, the same kind of idea. So the market swings to the upside, correct. Swings to the upside, correct. Forms its swing high, the resistance level, breaks through the swing high, closes above it, looking pretty bullish at this point. But for whatever reason, on the next day, the bears came out, or those that were holding long came out, sold the market, and by the end of this day, we are significantly below the red line and significantly below the previous bar's close as well. So the market, the buyers basically are trapped, and this gives you the impetus for a flush out sell, an opportunity to make money on the downside here. On the way down, the market bounces up from this support level, forming a swing low. The sellers come in because the trend now is down. They push the market down, breaks through the support level, attracting selling. But by the end of the day, the market is significantly up again, significantly up above the broken support level, the swing low. So now we've got a situation where these guys are trapped. The market is now looking ready for a short squeeze, and that's what effectively happened. The market squeezed higher. Dollar Swiss daily. So now we have a situation where the market has a nice aggressive swing to the upside, pullback, settles into a sideways range, breaks through the resistance level within the sideways range, and within a couple of bars, the market retraces lower. Break, making a new high, retrace, the trap is in. And before you know it, people start selling it, and then when push comes to shove, the market crashes. So nice opportunity to make money on the short side. Market getting a little bit overextended down here, about the 104 level. Big snapback. Next day, higher again. So powerful short squeeze because this move needs to unwind. Sellers come back in after the short squeeze, correction. Sellers come back in, push the market to the new low. Again, last few pips of the bear market, break through the support level, closes back above it significantly. Next bar tries to break down, but closes fairly close to where the previous day's close was, top of the range. So there's no selling pressure on these 2 days, no real selling pressure. Break, retrace, and within a couple of days, we're starting to rally quite aggressively. Cable, daily chart cable, 3 examples here, 2 buys and 1 sell. So cable swings to the downside, some aggressive selling there, thrust, bounce back, pushes through the support level, can't close below it. Next bar, tries to push down again. By the end of the bar, here we are, we've closed significantly above the broken support level. So this is a break and retrace to the upside. So these guys are now trapped. Market then rallies quite aggressively for the next few days. Top out, market starts going down, forms a support level, a swing low here, breaks through, closes at the swing low. Next bar tries to push below it, closes significantly above it. These guys are trapped. Break and retrace to the upside. Opportunity to buy the market. Powerful, powerful squeeze, which actually turns out to be the start of a new bullish trend. After the correction, market pushes up, pulls back, breaks through the swing high, can't close above it. Next bar pushes up, can't close above it. Two attempts at trying to break through the swing high, can't close above it. Something wrong. Market starts to retrace lower, and that's these guys getting out of losing long positions. Aggressive selling. And now we have a situation where the market's trying to trend lower. Okay, so again, just to kind of recap, you can see just through the examples that I've shown you that the false break of support, false break of resistance can give you a kind of an early warning that a trend may well be about to change. So if you happen to be holding long and you see a false break of resistance, then maybe lighten up on your long position and think about something else, or maybe even think about flipping it and going short. Okay, so how do we prepare for an FBR sell? Number one, identify a good swing high with a good left and right strength. So what do I mean by left and right strength? As I mentioned, a swing high is defined as a high which is higher than the bar to the left, and it's higher than the bar to the right. So that is left and right strength. So if the swing high is higher than 2 bars to the left, it's stronger in terms of resistance than a swing high which has only got 1 bar lower to the left, and so on and so forth. So the idea is to identify a good swing high and then wait for the market, draw the horizontal line to denote resistance, and then wait for a retest of that swing high. If we can break through the swing high, then we have a new high bar, NH. So now what we've got labeled is R for the swing high, resistance, and NH for the breakout bar. Now, what we need to do to get ready to sell is draw a line at the lowest point of the NH bar. So once you've done that, we are ready to sell the market. We put a stop loss, not a stop loss, but a stop entry to sell the market if it breaks through the low of the NH bar. If the short's triggered, we're going to place a protective buy stop above the NH bar high. You could use a tighter money management stop if that distance is particularly large. I would think it's good to enter in multiple units or in a size which can be divided up into multiple units when you take profits, because the idea is that we take profits at 3 places, two places, or maybe sometimes 3 places, PT1, PT2, and PT3. So let's say that we sell short 3 units. Now that 3 units can be 3 lots. It could be 0.3 lots. It could be 30,000 shares. It could be anything, but a number which we can divide by 3 for when we take our profits. So when we hit our PT1 level, we're looking to buy back one of those 3 units and then move the stop. We'll be trading the stop in the direction of the trend, locking in profits, reducing risk. And then we have a time exit, which kicks in after 3 to 5 bars, which basically says, get me out of this trade because we spent long enough in the trade. So this is essentially what the FBR sell setup, sell trade looks like. So the market starts off in a situation where we have nice aggressive buying. So close above previous bar's high, close above previous bar's high, nice thrusting to the upside, aggressive buying. So the underlying tone here is bullish. The market then corrects back after this wave to the upside, correction back. And then typically after the correction, buyers come back in because the underlying trend is bullish, and they push the market to the new high. Now, as I say, most of the time, we would expect the market, having broken through this red line, to continue higher. because when the market breaks resistance, it tells you under technical theory that demand is greater than supply at that level, and that the price should continue to a higher equilibrium level. And that normally is the case. But what we're looking for here is a situation when that does not happen. Okay, so at the close of the NH bar, the bar on which we break through the red line, we can then say, okay, we've now got an R, a resistance, the swing high. We've got a new high, we've broken through the resistance, the swing high. Now we can say, okay, if this market breaks through the low of this bar, the breakout bar, then a top has most likely formed because we've got all of the buyers on this bar trapped. So we put our sell stop at the low, just below the low of this bar. Okay, so should the market break down and enter short through units, we're going to place a stop loss above the high of the NH bar. So our risk in terms of pips or points or ticks or whatever it is you're measuring in is this distance, high minus low. That's your risk amount. Okay. So now, once we are short, we want to know where we're going to take our profits. And I like to have my profit targets at a multiple, a percentage of the risk amount. Sometimes I can use ATR, average true range, as well. So we know where we're going to get out if we're wrong. If the market subsequently bounces back up, breaks through this high, we don't want to be short this market because it's most likely a resumption of the uptrend. But if we're right, everything goes well, we'll be looking to get out at these prices on the way down. Okay, so let's assume that we enter a short position for 3 units at the low of the NH bar. We have a stop loss above the high of the NH bar. And then when we hit our first target, PT1, what we do is we lower our stop loss from here, the risk level, to our entry point, which means that if we hit PT1, we've bought back 1 of those 3 units. So now we're short 2 units, we've taken profit on 1 of those 3 original units. And we've lowered our risk to 0 now for the rest of the trade because we've moved the stop to our entry point. Okay, so if the trade goes as we hope it would, and the market continues down, we hit our second target, we buy back 1 more of those units. And then we lower the stop from the entry point to PT1, which means that if the market snaps back from PT2 to PT1, then we take our profits on the remaining unit that we have. If we're really lucky or the trade runs totally as expected, we hit our third target. Oftentimes I won't use a PT3, I'll just get out at the end of the trade, which I call a time exit. So after the 3 to 5 bars, whatever number you choose, you just get the hell out and walk away, take your profits and say thank you very much. Okay, so now the question is, how do we identify a situation where the market is in a potential buy setup? So first of all, we need to identify a swing low, and then we, just one second. There we go. So first thing is we have to identify a swing low with a good left and a right strength. So a swing low is lower than N bars to the left and N bars to the right. We draw our horizontal line to denote support, and we wait for a retest of the swing low, and we mark the low of the bar NL, the new low. So we draw a line at the highest point of the NL bar, and we get ready to buy if the market crosses above it. Okay, so this is essentially how the trade looks. So we have the support level, we get the bounce, we get the retest and the breakthrough, which is the NL bar, new low. And then we have a situation where once we break through the high of the NL bar, we go long 3 units. We buy, we put a stop under the low for the move, the NL bar, and we're looking for PT1, 2, and maybe PT3. And again, as the market goes in our favor, as we hope it will do, assuming we don't get stopped out, the market hits PT1, we sell one of those 3 units at PT1. So we've taken profits on one of those units, we've moved the stop to break even. So now, if the market reverses from PT1 and comes all the way back down to our entry point, we simply get out. We don't make any money on the other 2 units. We've made a small profit on one of the units, and that's the end of the story. But if that doesn't happen and the market continues higher, we sell another unit at PT2, we move our stop up again to PT1, and then hopefully we either get to PT3 if we're going to use PT3, or we just get out on the time exit after 3 to 5 bars. Okay, so just to summarize about the whole thing, the FBR FBS pattern setup. FBR and FBS patterns are seen at many important turning points, as I've shown you, and on every time frame, and on every market. So you recall the major high and the major low for the Dow Jones, which FBR and FBS pretty much nailed, 2007, 2009. So the disciplined trader, rather than try to anticipate the market topping out and making contrarian trades, good to wait for the formation of the trap, the break and retrace. So once you get the break and the retrace, let the market tell you that the market has run out of steam. So we get the push higher, the retrace lower, and then we know that there are a significant number of people who bought the breakout that are on the wrong side of the market. So that's essentially it. We're waiting for break and retrace, a formation of a market trap at a major swing high or a swing low for the chart you're looking at. And as I say, the patterns are valid on all time frames and markets, but obviously I would prefer to use them on daily, weekly, and sometimes monthly charts, because obviously they're a bit more reliable. On shorter term charts, there's a lot more noise and false breakouts in both directions. Okay, so that pretty much sums up the presentation on the pattern, on the setup. Are there any questions at this stage? No questions at this stage? Not a problem. Okay, if you happen to have any questions that you think about between now and the next webinar, I'd be very happy to field them. If you want to contact your CFI representative, or if you want to find me, I'm all over LinkedIn. If you want to contact me, ask me any questions about the content of the presentations, I'll be very happy to help. So for now, thank you very much indeed for attending, everybody, and I look forward to presenting to you again in the very near future. Happy trading.